A lot of investors have been talking about Celsius stock recently, and for good reason. The company's made several big moves, like making an acquisition of a company called Big Beverages. The company's revenue declined in the most recent quarter, surprisingly. The company's stock price has been extremely volatile. And so there's a lot of reasons why investors are talking about Celsius stock and trying to understand the latest developments. I wanted to elaborate a little bit and provide some coverage on why so many investors are indeed talking about this exciting growth stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So I highlighted that one of the reasons investors are interested in Celsius is because of a recent acquisition. They acquired Big Beverages, a long-term co-packer for the company, and this is intended to give them new innovation capabilities and greater control of their supply chain. And they believe that vertical integration like this is a capital efficient growth driver and another way they're investing in their long term vision to become a leading energy brand in the US. So, true that when you have more control over your supply chain, it allows you better innovation capabilities. You can have clearer communication channels with the manufacturer. And when you have an idea, it can go from idea to product more quickly with less friction. That's definitely true. Also, it gives you better cost controls and you can understand the changes better when you decide on a product. You can then make those calculations on how this product is going to impact your profit margins because you have control over your supply chain and you can understand better those cost levels. However, those benefits are offset by greater risk because now you have that in-house, that manufacturer in-house. And if your sales fall like they did in the most recent quarter for Celsius, your costs don't come down by as much. And so your fixed costs are now elevated and thereby the risks to the downside are more elevated. But offsetting that is that you have more upside because your costs are fixed. When revenue goes up, profits will increase because your costs are more fixed. And so there's a lot of give and take here with this acquisition and the vertical integration. And it's something that Celsius stock investors have been accustomed to. The company's taking an asset-light business model for the most part, partnering with Pepsi. But now this acquisition changes things a little bit. The company's more interested in vertical integration, something to keep an eye out on. So I mentioned revenue decreased approximately 31% to 266 million. And part of this reason is because of the partner Pepsi decreased purchases, and that impacted the company's revenue by 124 million. But that's not the whole story because even if you add that 124 million to the company's revenue, that brings it up to 390 million in the most recent quarter, which would have been up by only 5 million from the same quarter last year. So, yes, Pepsi's decrease in purchase did impact the company meaningfully, right? But also the overall category demand was not that strong. And management talked about that, saying that, people were visiting convenience stores a lot less frequently, traffic was down, and that partly explains why the overall market was down. Celsius, even with its revenue falling, said that they actually gained market share in the most recent quarter. So the international segment is an exciting story for Celsius. It's still in its early stages of growth, and the international revenue grew 37% to 18.6 million. Even though overall company revenue was down, international revenue was up because it's still entering new markets. It's still in the early stages of penetrating markets outside of the United States. And so this is going to be a growth driver for the company longer term as it enters into new markets and finds ways to distribute its products more effectively. That's going to be something exciting for Celsius stock investors. Now, the gross profit margin fell to 46%. down from 50% in the same quarter last year. But if you look at the year-to-date gross profit, it's still up to 50%, up from 48%. And these are excellent gross profit margins for a relatively new company. If you compare this to like the bigger brands like Coca-Cola, Pepsi, and Dr. Pepper, their gross profit margins are around this level, maybe a little bit higher at 60%, 65%. For Celsius to achieve these kinds of gross profit margins in the beverage category, being a relatively new player, is impressive to be sure. So even though their sales were down, they continue to invest and support their brand with advertising and marketing in a thoughtful manner without creating disruption to their ongoing campaign and investment. So just because their sales were down in the most recent quarter, they didn't begin cutting costs, cutting advertising in a panic mode just because sales were down in one quarter. They kept it going. And I think that's prudent, especially because in this category, in the beverage category, marketing and advertising is so important to success. You don't want to disrupt those activities just because sales were down in one quarter. And so because sales were down and they kept the marketing investments elevated, the profitability fell meaningfully. Net income in the third quarter was down by 92%, down to 6.4 million. Still, it's impressive that it was positive, but it was down from 84 million in the same quarter last year. Part of the reason why investors were so excited about Celsius stock is because not only were they growing revenue quickly, but they're also growing the bottom line, profitability on the bottom line. And so this huge decrease really changes the story here. Investors are looking for a quick turnaround from Celsius, but management said the next quarter, the fourth quarter, it's still going to be challenged. The end markets for its energy drinks is still facing headwinds, and so the next quarter is not going to be that much better. But despite those pressures, they maintained a cash balance over 900 million, an excellent balance sheet, pristine balance sheet, and they're still generating positive operating cash flow this year, even with the headwinds. So longer term, the growth story remains intact for Celsius. It's gaining market share in a category that itself is gaining market share in overall beverages. Let me zoom out a little bit there. I think I may have confused a little bit. The energy drink category is gaining market share in the overall beverage category. And then within the energy drink category, Celsius is gaining market share. So Celsius is gaining market share in a category that's gaining market share. So it's got strong tailwinds behind it. And near term, there are some difficulties, some challenges, but longer term, those tailwinds remain intact. And so it's exciting times. And I have said this before, but this dip, I've called it a buying opportunity. You can see here, I've rated Celsius stock. I rated it as a buy following the company's recent pullback, following the company's latest earnings results. I rated this stock as a buy, and I last updated that on 11/20th, which is today as of this recording. I'm reiterating that I think this stock is a buy on the dip. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.